Hello, welcome back. This lecture is on candlesticks. The majority of traders use candlesticks. The reason is because they give additional visual information on when a reversal is possible. If you'll open your book to this page, on the first box on the left side, you'll see that you have one candle with a small body and large wicks. What this represents is that buyers have pushed the price up, but then sellers have pushed it way back down, and this gives us evidence that the price is going down. But before we place a trade based on that evidence, we need to look at other evidence also, such as support and resistance lines that we covered in the previous lecture. This is the simplest way to trade Forex, and as some would say, the best way to trade Forex. Support and resistance lines with a combination of candlestick patterns. On the candle next to it, you'll see that you have a very small body and large wicks to the downside. This represents a price where sellers have pushed the price down, but then buyers have pushed it back up. And this gives us evidence that the price is going up. And if this occurs at a resistance zone, then that's further evidence and could be a potential good setup. Obviously, it's not going to be a 100%. Nothing is 100% when you're trading Forex, but as long as the probability is high enough, it might be enough to open the trade. In the box below that, we have Marubozus. You get a lot of these Japanese terms because this is where the candlesticks originated in Japan. So you have those, you have dojis, and other stuff we'll get into in later lectures. With the Marubozus, you have strong evidence that either the bulls or the bears are in control. If the entire candle is green, just the body, there are no wicks, then the bulls are in control. If the candle is red, then the bears are in control. Below that, we have the dojis. Dojis are tiny bodies or no bodies at all with large wicks. These are considered indecision candles, and if they occur at a support and resistance zone, then they could be a potential reversal there. In the boxes to the bottom right, you have two candle setups. The first candle is a Marubozu followed by a doji. When this pattern occurs at a support and resistance zone, then it becomes a valid setup. Now let's go to the MT4 platform and see if we can locate some of these candles. Here is a doji, but let's add the psychological levels. There we go. Here is that two candle pattern that we discussed. And you can see that it did work out. And here's an example of that same pattern where it did not work out. Here's another example where it did work out. The price went in the direction that we expected. In the next lecture, we're going to go into more on candlestick patterns, mostly the single patterns and the dual patterns. See you there. Hey there. In this lecture, we're going to cover single candlestick patterns and double candlestick patterns. Now, these patterns work on all of the time frames, but from my experience, they work best on the daily time frame. We're going to cover the pages single candlestick patterns and dual candlestick patterns. And let's put that up. The first single candle pattern we're going to look at is the hammer. The hammer has a little or no wick on one side and a large wick on the other side. The larger wick has to be twice the size of the body, and this is what it looks like. When this candle is at the bottom of a trend, then there is a possibility of a reversal. Let's go to the MT4 platform and see if we can find one. Now, this indicator we put on there sweet spots. It has a lot of lines, it could be distracting. Let's reduce that number some. To edit this indicator, we right click on the chart and click on the indicator and then edit, or you can double click. Then go over here and set this to false, and that will only show the whole numbers. The next single candle pattern is the hanging man. This looks similar in appearance to the hammer, except it occurs at the top of an uptrend and it signals a bearish reversal. Let's try to find one on our platform. And there's one there. The next single candle pattern is the inverted hammer. It looks like the hammer, except the body is at the bottom, and like the hammer, it signals a bullish reversal. Let's try to find one. That's one there. Okay. The last single candle pattern is the shooting star. It occurs at the top of a trend, and it looks like that. Now, for most of these candle patterns, for the single ones, the color of the candle, the body, is not that important. It's just where it's placed at the trend. If it's at the bottom of a downtrend, then it becomes valid. If it's at the top of an uptrend, then it becomes valid, regardless of the color. Now on to the dual candlestick patterns. The first one we're going to look at is the bullish engulfing. In this two candle pattern, the second candle completely covers the body of the first candle, as you see in the infographic. This occurs at the bottom of a downtrend and signals a bullish reversal. Let's look at the platform and see if we can find one. There we go there. Then we have the bearish engulfing. The second candle completely covers the first and it appears at the top of an uptrend, and this signals a bearish reversal, and it looks like that. Let's see if we can find one on the platform. Now we'll get to the tweezers. First, the tweezer bottom. It looks like that. They are two candles together. They both have long wicks. The first one is red and the second one is green. That's for the tweezer bottoms. And it occurs at the bottom of a trend, a downtrend, and it signals an uptrend. So let's try to find one on the platform. There we go. And lastly, we have the tweezer tops, just like the tweezer bottoms, except they occur at the top of an uptrend and they signal a bearish reversal. Let's look for one. All right. The next lecture is going to be on the triple candlestick patterns. See you there. Hello, welcome back. This lecture is going to be on the triple candle patterns. Before we get into that, some of you are probably wondering about this indicator, sweet spots. There's still a few lines on there we want to get rid of. So the reason that's happening is it's an old indicator. So back when most brokers had 4 digits after the decimal, this was a good indicator. Now that most brokers have 5 digits, this indicator needs to be edited. So let's do that now. All right, let's get on the chart, right click, indicators, sweet spots, edit, and change this 100 to 1000 and change this 100 to 1000 and this 25 to 250. And that should do it. Close it out, and now we see it looks like the way we want it. So let's continue on with the lecture. Now with triple candlestick patterns, they're made up of, you guessed it, 3 candles. The first one we'll cover is the evening star. This one has a bullish candle followed by a doji, and then that is followed by a bearish candle. This occurs at the top of a trend and signals a downtrend. Let's try to find one on our charts. Okay. The next is the morning star. The morning star is the opposite of that. It has a bearish candle and then a doji followed by a bullish candle. It's at the bottom of a trend and signals an uptrend. Let's see if we can find that on the chart. All right. The next one is 3 white soldiers. This one occurs at the bottom of a trend and consists of 3 green candles, 3 bull candles. And 3 black crows would be the opposite of the 3 white soldiers. And let's go to the chart and see if we can find them. Okay, and there's that. The bottom box of the infographic has the 3 inside down and 3 inside up. The first one is a bearish reversal, and the other one, the 3 inside up, is a bullish reversal. And this is what it looks like. The candle in the middle is an inside bar, and that is within the bounds of the previous candle body. We are disregarding the wicks on these inside bars. And let's go to the chart and see if we can locate them. All right. And okay. Now to make all this even simpler, I've included an indicator in the resources that detects these candlestick patterns. So to add it to your platform, just download it from that link. Like before, go to the MT4 platform, then open data folder, and then close out the platform. Then in that folder, you want the MQL4, and inside there is the indicators. That's where you drag your new indicator. So let's do that. And then we're going to reopen the platform. Now let's drag this indicator onto the chart, and we'll see that in the top left there is a legend that tells us what the letters mean. And there is an SE. What does that mean? A bearish engulfing. And SS3, shooting star. Now, when you wait for these to appear at the psychological levels, those sweet spots, then we have a pretty good setup. That should do it for candles for now. On the next lecture, we're going to go over moving averages. See you there. Hey there, welcome back. This video is going to be on moving averages. The moving average is probably the most popular indicator that is applied to a chart. The moving average can be used as a lagging indicator when it's used to identify a trend, and it can be used as a leading indicator when it's used as a dynamic support and resistance line. So what exactly is it? It's the average of the prior candles. So if you have a 10-period moving average, the line would be the average of the previous 10 periods, the previous 10 candles. It's usually set to the close price of the candle, but you can edit that to the high of the candle or the low or a weighted average. The SMA is the simple moving average. What that does is you just add up the last 10 candles if you have a 10-period average and divide by 10. and then you get the SMA, the simple moving average. And you can use whatever period you want, 25, 50, 100, 200. Those are all popular ones. The SMA is good for determining trends. You can use it to help filter your trades. For example, if the price is above the line, then only enter long trades, and if the price is below the line, then only enter short trades. The EMA is the exponential moving average. That gives more weight to the more recent candles, so it follows the price more closely. As you can see in the infographic, the EMA is the yellow line and the SMA is the purple line. The yellow line follows the price a little more closely. So how do we use these moving averages in our trading? Well, like I said before, you can use it to filter your trades. For example, this is the moving average. You have your price up here, then only enter long trades. If the price is down here, then only enter short trades. Another way people use the moving average is with the moving average crossover. They apply two moving averages to the chart, both with different periods, and when one crosses the other, then they have a trade set up. This works very well during trending markets, but it fails in ranging markets. Trending markets is when the market is either rising or falling, and ranging is when it's a sideways market. Another way people use the moving average is as a dynamic support and resistance. Say you've determined that the market is rising, so you only want to trade long positions. And the moving average is here, price is here, so every time it comes down to the moving average, you have a trade set up for another long. And that's how some people do it. In the bottom right box, you have a 7-period SMA and a 21-period SMA. One potential strategy you can use is when price crosses both of them and then crosses back the other way in your intended direction, then you enter the trade and set your stop loss at the further line. And your take profit, whatever your stop loss amount is, just double that or 1.5 times, depending on what you prefer. Now, the strategies that I'm mentioning in this course, they're just ideas that you can use when coming up with your own strategies. You can combine them, just use it as it is, or just disregard it. Most traders eventually conclude that it's best to just disregard most strategies. As I've mentioned before, most institutional traders, they don't use any indicators other than support and resistance lines and maybe one moving average as a trend direction. Now let's go to our MT4 platform and apply the moving average to the chart. The moving average is included with the platform, so you don't have to download it. It's already there. Just double click it or drag it onto the chart. Here you can edit what the period is. You can edit whether it closes on the high or the color, the width. And then when it's on the chart, you can drag back to see how it performs. If the chart snaps back to the current price, then you need to click on this button, and that allows you to drag the chart back to previous times. And to get back to the current price, you just click this button again. That's it for the moving averages. The next lecture is going to be on RSI. See you there. Hey, welcome back. This lecture is on the RSI. The RSI is the relative strength index. It measures the ratio of the up moves and the down moves and presents that information in a range of 0 to 100. So to take a look at it, if you're following along in your book, turn to the page that says RSI, and we'll put it up here for you. It is an oscillator. This means that it opens a separate window below your price, and it has a line that oscillates up and down. The 70 line on that window is the overbought line. Anything over that line is overbought, and the 30 line is oversold. Anything below that line is means the market is oversold. You could trade it like that, but there is a better way to trade the RSI, and that is as a trend continuation indicator. For that, we need to add a 50 line to the indicator instead of these 70 and 30 lines. So let's do that now. Open up your MT4 platform and apply the RSI indicator. This is included with the platform, so we don't have to download it. First, let's delete these other indicators so we have a clean chart. So just double click on the RSI and it's applied to the chart. Now with the default, you have the 30 and the 70 lines, but we want to change it to only a 50 line. So to do that, we need to edit it. Right click on the chart and then go to indicator list, then RSI, and then edit. Go to the levels tab and delete these two levels that you have there. Then add a new one for the 50 level. Click OK, then close. And as you'll see, the 50 line is now there instead of the 30 and the 70. So how this works is that the trend will continue once the RSI crosses this 50 line. That's the idea anyway. To see it better, we're going to use this crosshair button, and then we can see where the price matches up in the RSI indicator. You can also filter your trades by adding a moving average, an SMA, simple moving average of let's say 50. So let's do that, 50 SMA. This is optional. Also, you can adjust the settings of the RSI. The default is 14, but some traders prefer a setting of 5. So to do that, just change this 14 to a 5. This strategy is good for several different time frames, the 1 hour, the 4 hour, the daily, the weekly. Just test it out and see which one works for you, or if you like this indicator at all. Remember to set a take profit and a stop loss on your trades. To show that, let's go ahead and put in a trade now. Right click on the chart, then trading, and then new order. Change the volume or the order size to the minimum of 0.01. For the stop loss, let's use the swing low on this chart, and that's going to be at this price point. And we'll measure that, and it goes to about 38 pips. And then for the take profit, let's use that 38 pips, and we'll have a 1-1 stop loss take profit. And put that price level there in the take profit box. Remember, we're only practicing here. This is a demo account. Even in a real account, we would start off with the minimum size, just so we get the hang of it. So that's why we're using the minimum trade size of 0.01. And then to see your trade, click on the terminal button here, and you can see that your trade has been placed. To close it, just click the X. If this is your first time, this box will appear asking if you want to turn on one-click trading. Okay. And then just click the X again and your trade is closed. Another way to place this order is to click this down arrow in the upper left corner. That opens up a buy-sell box. Change this order size to the minimum of 0.01. Then click the buy button and your order is in. Then drag this line down to place your stop loss. Drag it where we had it before, just past the swing low, and that sets your stop loss. And you can see it's updated at the bottom. And then to set your take profit, just drag this order line up to where you want your take profit to be, and let go. It'll automatically close your trade once one of these two lines are hit, or you can close them manually by clicking the X here. So let's go ahead and do that. And that's it for the RSI. In the next lecture, we're going to go over the MACD. See you there. Hey, welcome back. This lecture is going to be on the MACD. No, it's not the name of a rapper. It's the Moving Average Convergence Divergence. It's used to identify new trends, and it is a lagging indicator, meaning that it follows price. It doesn't predict the movement, but confirms the movement. The default settings are 12, 26, and 9. The 12 is the number of the periods for the fast moving average, and the 26 is the number of periods for the slower moving average. The 9 is the signal line. You can adjust these numbers in the editing. If you choose, the creator of the MACD has chosen these default settings because, according to him, they're the best settings to use in a fast or a slow market. When the lines on the MACD cross, that's when the zero line is crossed on the histogram. If you'll notice on the purple chart, the lines that cross, there is a corresponding cross on the histogram below it of the zero line. Also in the histogram, as the bars increase, that's the distance between the two lines of the MACD. And as they're increasing, that means the momentum is increasing. As it's decreasing, it signals a new trend is coming up, and at the cross of the zero line, that's usually the time you should enter. Now let's put it on our trading platform. This one is also included with the platform, so we don't have to download it. Just double click from the indicators folder. This doesn't really appeal to me, so let's put a better one on there. From that, we go to the resource sections and download the MACD indicator and also the alert indicator that's there, and we have them here. We go to File, Open Data folder, and MQL4, and we're going to put them in the indicators folder, and then reopen the platform. Now, how to trade the MACD? You can enter at the crosses of the lines. That would be the more aggressive approach. Or you can wait for the cross at the zero level of the histogram. And I believe these two indicators, they give audible alerts when there is a cross occurring. The arrows up on the price indicates where the crosses are on the window below. A little easier to monitor. This is one way to use the MACD. Some traders use it another way, and that is with divergence. We're going to cover divergence in a later lecture, but I'll just mention it here since we're on the MACD. You compare the peaks of the MACD with the peaks of the price chart above it, and when there is a discrepancy, then that signals us of a potential entry. Let's try to find one of these divergences on the chart. Okay. And looks like there's one here. We can draw the lines. Click the diagonal line, put one here, and put one here. And as you can see, the angles are different, so that means there is something about to happen. And you would make the trade in the direction of the angle of the MACD. I believe in the lecture on divergences, we're going to include an indicator that draws these lines for us, so we don't have to do them manually. And that's it for the lecture on MACD. In the next lecture, it's going to be stochastics. See you there. Hey there. This lecture is going to be on the stochastic. Before continuing, if all these indicators seem a little overwhelming, just remember you don't have to use them. We're just covering them because they are a part of trading, and I want you to become familiar with them so you can conclude that maybe you want to use it or maybe you don't. But just don't become overwhelmed and stick with it. Remember, we're going to make you professional traders. Stochastics is an oscillator. It measures overbought and oversold conditions. Just like the MACD, there is an overbought line and an oversold line. These are set at the 20 and 80 levels. It has two lines. A fast line is the %K and the slow line is the %D. If you are interested in the calculations, here they are. They're a little complicated, but you don't have to worry about any of that. The platform takes care of all the calculations for you. The common settings are 14.55, 14.33, 5.33. I believe the default will be 14.55. It varies on the broker, but you can adjust these to whatever you like. One way to trade these is when the two lines cross, when they're in the overbought or oversold areas. And as an added filter, you can add a trend indicator such as a moving average. Another way to trade this, and the more conservative approach, is to wait for the lines to cross back over the 20 and 80 lines. That way a trend reversal is confirmed. Okay, let's go to our MT4 trading platform and see if we can put this on our charts. This one is also included with the default indicators, so just double click the stochastic under the indicators folder. In this case, the settings are 533. To change them, just change the numbers. Let's make this a 14. Okay. First, let's find the cross of the lines. There's a cross there. And then the more conservative approach, wait for the lines to cross back over the overbought and oversold levels. That would be right there. And then as a filter, we'll add a moving average of 50 and only take trades in that direction. You could use Stochastic as a divergence indicator also, like we did with the MACD. It works the same way, so if you want to see how that works, just rewatch the MACD lecture. You can even add a second Stochastic on top of the first one, and when both of them are in correlation, then you have a better setup. To show that, let's add another Stochastic to our chart. We'll set one of them to 14.55 and the other one to 56, 20, and 20. And just back test and see what results you come up with, what settings best work for you. That's it for the lecture on Stochastic. The next one, we're going to go over PSAR, P-S-A-R. See you there. Hey there, welcome back. This lecture is going to be on Fibonacci. The Fibonacci indicator is a leading indicator that works really well. Fibonacci was a mathematician in the 13th century. He made the Fibonacci sequence. The sequence goes like this. There is a 0 and a 1. You add those two together and you get a 1. And then you add the last two numbers, the 1 and 1 together, and you get a 2. Then you add those two last numbers, the 1 and the 2 together, and you get a 3, and so on and so on. And then when you start dividing the two numbers, you get a number that comes close to 1.618. Now this 1.618, that is also known as the golden ratio or the golden mean. The golden ratio measures accurately many things in the world, such as the distance between joints in the human body, the solar system, universes, galaxies, all the way down to DNA structure. So a lot of things. In trading, we use Fibonacci retracements and Fibonacci extensions, or profit targets. Fibonacci retracements are levels where from the high to the low, and then the price will retrace back to one of the Fibonacci levels, and then continue. Or from the low to the high, and then it'll retrace back to one of the levels. These levels can also be called support and resistance levels. A lot of people like to match up the whole number psychological levels with the Fibonacci levels for a stronger support and resistance level. Now for the Fibonacci extensions, or sometimes some platforms call them expansions, those give you profit targets to go for. These levels are the 1.27 and the 1.61 Fibonacci levels. To see how this works, let's go to the chart, open up the MT4 platform. To put the Fibonacci level on the chart, you just click this button over here with the little F on it, and then you draw a line. You pick a high or a low, and then you go to the high or a low, and that will draw the retracement levels. That's the easy part. The more tricky part is the Fibonacci extensions. That is done in two ways. The first way is to draw a line from the high or the low and to the other extreme, and then draw the second line to the retracement. The second way of doing the Fibonacci extensions is drawing a line from the high or low to the other extreme, and then drawing the second line back to where you started, so the 1.0 level matches up to the end of that first line. Then you can see where the extensions are, where you set your profit targets. To make it a little simpler, I've included a Fibonacci extension indicator in the resources section of this lecture. So go ahead and download that, and let's attach it to the chart and see how it works. Drag it to the indicators folder, which is inside the MQL4 folder, and then restart your platform. Click on the navigator and then double click on the indicator. And as you can see, it tells you where to enter the trade, where to place your stop loss, where to place your take profits, different take profit levels. And they're all based on Fibonacci sequences. A note on the indicators that are included with this course: I am not the creator of those indicators. I came across them during my research, and to find the creators, just open them up in the editor and you can see who actually created them. All credit goes to the creators of the indicators. That's it for the lecture on Fibonacci. Again, it's very popular and a lot of people use Fibonacci levels exclusively in their trading. The next lecture is going to be on Bollinger Bands. See you there.